Your retirement is just a few years away. It may be time to adjust your investing strategy.
The shocking statistic is that by the time somebody reaches 65, 95%, they're dead broke, they're dependent on family, or they're dependent on government.
It's important that people deal with someone to make sure to prove and provide that guaranteed lifetime income.
Welcome to the Retirement Architect, David Reyes. Our program is designed to not only provide insight, but to educate and to give you the tools you need to help you design and build a rock-solid retirement.
What a weekend we had. If you missed it, the Masters, unbelievable. Tiger Woods completes a comeback to win his 5th Masters and his 15th major. Unbelievable. It snapped a decade-long streak for him, and he's important to the sport. It's funny, even the stocks of like Nike and some of the other sponsors he had went up like 5%, 6%, 7%, which is hilarious because he lost a lot of sponsorship when he had his little issues with his wife, and he had some issues with some painkillers and drinking, and I think a lot of you know the story there. So I'm really happy for him. Everybody likes a comeback story, and what an amazing tournament. It's probably his greatest bogey ever. He had a bogey in his last hole on a 2-putt and won the championship. So, Tiger's at all-time highs again, right? His life, his golf. Here he has had a girlfriend for a few years, so he's kind of stabilized over the last few years. And so, congratulations, Tiger. That's awesome. And you wonder probably why am I talking about Tiger Woods relative to investing? And I'll get there. But many people don't know that for a while, Tiger was not even ranked in the top 1,000 in 2017. That's amazing. And many wrote him off because of his off the field, off the golf course escapades. And it's truly amazing. I think he's 43, if I'm not mistaken. And to win a Masters championship at that age is just amazing. So, but it went through a lot of struggles to get there. And, markets are kind of like that. It reminds me of 1999 when we had this market soaring. The 90s were the most, the greatest stock market decade ever. Stocks average about 20%, and bonds were in the mid 4, 5, 6 range. So having a balanced portfolio of stocks and bonds back in the 90s was like the holy grail. That was the Goldilocks period, which we'll never see again, in my humble opinion. Interest rates today, they're in the 2% range. And stocks we're probably at the peak of the market here sometime in the next 12 to 24 months. And so forward returns are going to be pretty negligible. A 13-year period that we had from 2000 to 2013, the stock market went nowhere. Think about that for a minute. Zero, nowhere, nada. So really from 2000 to 2013, all the gains have been made since 13 to 2018, 2019. Over the last year and a half, we've gone nowhere. And we've had 10% up and down markets and down 20 and up 20. So, that's a volatile market. And all said and done, we're kind of back where we started from almost a year and a half ago. So, buy and hold for a lot of people sounds good. But unfortunately, being human beings that we are, most of us are going to buy high and sell low. We have one of the most aggressive markets right now where there's a lot of buyers that are very enthusiastic about the market. And so, these frailties that people have with their psychology is kind of like what Tiger had. Tiger, he's a human being, right? And he went through these same issues relative to the struggles he had, like the struggles of the market. And we're all dominated by fear and greed. Those are the things that dominate our lives. And so when we have these types of dichotomies of how we react, then it's going to cause problems for us. So right now you have the markets at valuations, historical overvalued valuations, historical. So meaning a handful of times. And unfortunately, people are starting to buy a lot more stock, and that's what happens at peaks of markets. So you got to be careful out there. Advisors and clients are starting to really get back into the markets at a really feverish pace. And the problem is, just like golf, it's like I call it, the old saying in golf is, drive for show, putt for dough, right? And just like Tiger made his 2 putts to win the Masters, think of the analogy of the market. The market's at this big swing, and now we're on the putting green, right? And that's where really the real investment acumen means something. Just like winning the tournament, making that putt. Also, how do we all of a sudden at this time frame when we've had such these gains that have happened recently? How are we going to adjust? How are we going to make the good decisions to win the game? And part of winning the game is winning by not losing. And so right now, if you've had the good fortune, because it's fortunate, the market was down 20% from October to December, is now up about 16% for 2019 and up 20% from the bottom. Those are not normal markets. And so there's lots of reasons for that. But right now is a time to do a timeout. Timeout. And what's happening right now is called a FOMO market, fear of missing out. And that's what's happening. And I know that because I sit down with you every day, and I've got prospective clients that are, David, I want to hire you, but meaning that what's happening with them is, well, I want to see how high the market can go. And so when I hear that, that's basically a tell. The market, people are too aggressive on stocks. I mean, I can count about a half dozen clients that we'll probably end up getting. But the fact is, it's going to be too late. Not too late, but they're going to probably lose more money than they like to, because the fact is that people don't sell high. They're going to panic like they did in October and sell low. And so I had clients bringing over tens of millions of dollars in the fourth quarter of last year and losing hundreds of thousands of dollars just on the transfer of assets. So don't let that happen to you. And so how can you deal with that? Well, what I would recommend that you do is you need to reevaluate your portfolio today. And we got to see what kind of risk you have, what kind of fees you're paying, those types of things, because the fact is that most of you have a more aggressive portfolio than you think. So what we offer to all of our clients and prospective clients, and when I teach and those types of things, and we're also going to start doing workshops at our offices, I think, in the next month or so. So be looking out for that. We're excited about that. We're going to be doing some evening workshops and hopefully some lunch and learns. But if you want me to sit down with you and evaluate your portfolio today and see what kind of risk you have today, because it's kind of like getting in a car accident, right? If we get in a car accident and don't have any insurance, it's too late, right? The market's no different. If you start looking at, oh my gosh, I should look at my portfolio and get it reviewed after the market's down 10, 20%, it's too late. So we have to have protection all the time. We have to have insurance all the time. And so what we're good at doing is mitigating risk. We want to mitigate risk. We want to have conservative growth and ultimately good income. So if you want me to review your portfolio, look at the risk you have, look at the fees you have, do a retirement income plan for you, just reach out to me at 1-800-611-1967. That's 1-800-611-1967, or go to reyesplan.com. That's REYES plan.com. So I can't reiterate how far this market has come. I think it's either the first or second fastest, win streak, fastest time to a 20% bottom from bottom to top. And so, again, those are not normal markets. And there's a lot of technical reasons I won't get into. Earnings are really lagging. This market is kind of floating on thin air right now. And so I can't stress more than enough that it's a good time to reevaluate what you have. I want you to protect what you've worked so hard to have. And in retirement, it's not about doubling our money. It's not about – what it's about is maximizing income. And I have a saying I've used for years. You've probably heard me say it, or if you heard me speak, is that we want to have the most amount of income with the least amount of risk and never run out of money. Now, what is that? Is there any part of that I'm saying double your money? Let's earn 25%. We have a rule. We say it's the 5 to 10% golden rule. If we can be in that range, of let's say 5% really is where we want to be, and we can have methodical returns in that 5% range as opposed to having these big up 10, down 10, up 20, down 20, that's not going to help you, and that's not going to give you a successful retirement. So again, if you want to reach out to me and give you a complimentary second opinion, again, I'll review your portfolio. I'll look at the risk of your portfolio. I'll look at the fees in your portfolio. I'll tell you, for most times, we're cutting our clients' fees in half. And part of making money is saving money. My partner is also a CPA, so part of making money and saving money is reducing taxes. So if I can just reduce your taxes and your fees, basically people hire me for free, meaning that the value add to what we're doing for you really, really compensates for the value that you receive. So again, if you want to reach out to me, you want to get a serious second opinion, again, complimentary, risk. We'll look at your portfolio mix. We'll give you the things you should keep and not keep. A lot of times you have things that are good. Let's keep those. But if we can improve upon that and maximize what we have, that's all the better. So again, give me a call. Complimentary second opinion, free, no cost. It will come from me personally, David Reyes. 1-800-611-1967. That's 1-800-611-1967. And hang on, we're going to talk a little bit about. I talk quite a bit about it, but I do want to touch on this again today. We always talk a lot about endowment investing and how endowments manage money. And we're going to kind of dig into the reasons why you should care, how Reyes manages money, which is kind of a direct relationship to how big endowments and institutions manage money. I want to talk more in detail about that. This is David Reyes, your retirement architect.